The US is dominating the global stock market like never before. It now makes up 56% of the entire world's market and is worth more than Europe, China, Hong Kong, Japan, and India's stock market combined. We've only seen this level of dominance once before, the year 2001. And when the dot-com bubble burst, what followed was a decade-long stretch where US market dominance fell and US stocks underperformed the rest of the world. It became known as the lost decade. Now, 2 decades later, those lost decade comparisons are starting to resurface, and some analysts are seeing early signs that global capital may be slowly rotating away from US markets. So far in 2025, the S&P 500 is up about 15%, but several international markets are doing much better. Germany's DAX 40 is up more than 30%, and broader indices like MSCI World and emerging markets have also outperformed US stocks by a meaningful margin. At the same time, many global fund managers now even expect international equities to continue outperforming going into 2026. At first glance, the case for international markets outperformance seems straightforward. Over the past 15 years, US stock valuations have surged far ahead of the rest of the world. Today, US stocks trade at roughly 22 times forward earnings. International markets, on the other hand, trade closer to 15 times. That's one of the widest valuation gaps we've seen in decades. And historically, valuation gaps like this tend to close, either through US underperformance, international outperformance, or some combination of both. So it's easy to look at these numbers and conclude that US stocks are simply too expensive. However, that explanation only tells half the story, because this valuation gap didn't appear out of nowhere. Over the past 15 years, US corporate earnings have quadrupled, while earnings in the rest of the world have only doubled. In other words, US companies arguably have earned much of this high valuation. Investors weren't irrational to pay more for companies with higher margins and better profitability. They were simply paying a premium in exchange for performance. A big reason behind that earnings outperformance comes down to where the US dominates, the tech industry. You can see it clearly in this chart showing patents in advanced digital technologies. Since the early 2000s, the US has consistently sat at the top. Today, it holds roughly 49,000 advanced tech patents, far ahead of China at around 28,000, and well above regions like the EU, Japan, and South Korea. These are patents tied to artificial intelligence, cloud computing, semiconductors, and data infrastructure, industries that have already reshaped the economy and are expected to double or even triple in size over the next decade. This explains why the US stock market has actually outperformed international markets over the past 15 years, making this year's case very unusual. This innovation and market leadership are really what people mean when they talk about American exceptionalism. And with earnings still expected to grow from those industries, one could once again argue that US outperformance could resume. However, earnings aren't the only thing that determines which markets outperform. See, even during the lost decade from 2001 to the early 2010s, US corporate earnings were still growing by more than 100% despite enduring recessions. And yet, US stocks dramatically underperformed the rest of the world. America's share of the global market fell from around 55% to just 30%. There is another important force at work, and that is the US dollar. During that decade, the US dollar entered a prolonged downtrend, losing roughly 40% of its value, and that dollar weakness quietly became a powerful tailwind for international markets. When the dollar starts to weaken, returns on US assets don't look as attractive, especially for overseas investors. For example, a European investor making 10% on US stocks could actually lose money if the dollar drops 15% against the euro. As this happens, capital tends to flow out of US stocks and into international markets, where currency depreciation is not eating into returns, which lifts their performance relative to US equities. If we zoom out further, we see the same relationship repeating. In the 1970s, periods of sustained dollar weakness coincided with strong international equity performance. In the 1980s, the same thing happened again. Strong dollar regimes tend to favor US assets, while weak dollar regimes tend to favor the rest of the world. And that brings us back to today. So far this year, the US dollar is down roughly 10%. At the same time, the US is running large budget deficits with rising concerns around debt sustainability. Many economists believe this could still put downward pressure on the US dollar. If that's true, then this isn't a story about US exceptionalism suddenly ending. Even if US companies continue to dominate in technology or earnings growth remains strong, a weakening dollar could shift the balance toward international markets, not because US companies suddenly become worse, but because the currency backdrop changes. And that's the variable investors may need to pay closer attention to in the years ahead. At Capital.com, we'll continue tracking how earnings, valuations, and currency dynamics shape global markets. Hit like and subscribe to stay tuned. Thanks for watching.